Yeah, I love that explanation, Mike. I'm glad that you put like a rough figure on that there around the 550 range, because I had spoken to Sam about this before as well. In me trying to build out my portfolio of like, what's, if I can have a large borrowing capacity, should I buy something around 800, 900k, or
Mm.
should I like what should I buy like two at 400k instead?
Yeah.
And the supply and demand thing is huge, and I'd love to have you sort of answer why maybe two 400k properties, Sam, versus like one 800k property in terms of like supply and demand and growth factors. If you can jump in on that.
Yeah, looking at the budget of say $800,000 or $900,000. Look, I'd always go for what is the best quality asset. I don't like owning say 50 investment residential properties, because then you've got 50 kitchens and potentially 100 bathrooms to maintain and all that. I'd look at it from an asset point of view first, but I personally, from an investing point of view, hits on the nail on the head. What you mentioned before is I try to target areas under $750,000, just because they are that more affordable price point. And then when you do see those stressful times in the market where you do get, say, the economic times aren't as strong, then people, if they do have to sell their $1.5 million house, they still need somewhere to live. And then from a risk mitigation strategy even further, I look going, well, generally they're not going to want to try and jump into the rental pool if they don't have to. So they might sell their $1.5 million asset, use that, and then still buy that security of a home that is, say, $750,000 or $650,000 that they can quickly afford. And they tend to be more, I guess, robust, as you mentioned, from I guess, not even from a price decline, because I'm that risk mitigation mindset of a valuer. I'm always looking at worst case scenario, but also on the best case scenario, I'm looking at it going, well, it can multiply, like a $750,000 property could multiply to $1.5 million, potentially a lot faster than a 1.5 can multiply to a $3 million property, because there's less people in that pool looking to purchase it. Looking at the $800,000 or $900,000 example that Jaryd mentioned, I'd go further and say, well, let's see what we can seek out. And it might be that we find a really great asset for, say $650,000. And then it's like, well, based on that, we've only got we've got 150 to play with. Let's park that, increase that deposit size, and then go again in maybe 12 months' time. But the other flip side of that coin is, well, you can probably get two really good $450,000 assets in your portfolio. It just depends on, Jaryd's portfolio size. He's got two properties. We're going for a third at the moment. And it goes into that category of, well, what's your risk appetite and what's your goals for this purchase? And it's definitely coming to a time in his portfolio where we are chasing a bit more income, and he's got some really strong assets in one's in Queensland and one's in WA. So, yeah, diversification is pretty key. It might be a bit of a long-winded answer on my front.
No, that's perfect.
What are your thoughts on that, Mike?
Yeah, look, I think, you're far more educated on these matters than I am, but I think that it depends on the market, right? Like, so you could go somewhere for $650, buy something that's kind of blue chip in that market. Other markets at $650, you're kind of in a bit of a backwater, and you might have some issues with tenants or maintenance, or it might have to be an older style property. So I don't think there's any kind of hard and fast around, it should always be a 550 or a 650 or a 450. I think the location that you're buying in is probably number one most important, because what's happening, is there a shortage of rental accommodation as seen in the vacancy rate? What are the days on markets? What are the population movements? What are the demographics? What's the infrastructure pipeline like? So these are all probably more important things than should I buy something for 550 or 500 if you've got that flexibility. But yeah, I do love the diversification of having multiple assets. I think you can take that too far and just try and hunt things that are 200 grand or something, which apparently are still available. But yeah, look, I just think if you've got $1.5 million to spend, you're better off looking at two or three properties than one individually.
Yeah, absolutely. And
Yeah.
I'm not
Diversification is key.
I'm not a guru like you guys.
Like, I guess, yeah, Jaryd knows more of this than anything, but you're right. Like, you start from the broad base approach and start, well, the screen's too small, but, you start narrowing your way down. You want to make sure that you're investing in the best locations initially, and then having that session around that. And then going, all right, once we've found those 2 or 3 target locations, then it's really important to find the right asset, because we can't print the perfect property. But obviously it's the opportunities that present themselves, and then you go into what you can do on that asset and how it fits your risk appetite, and also what your cash reserves are. A lot of people at the moment are running around looking for, I want a granny flat play, or I want to develop it, and they're not really educated into actually the costs that are involved with that, and the opportunity cost of what else could you be doing with that money at that stage. So it's always a constant education process.
Oh yeah, absolutely. And I think something that I talk a fair bit on my podcast is that the property is kind of like the exciting thing, but that doesn't mean that it should come first. I sort of equate it to dessert. Like if you're a good sort of a good country boy like me, you're always told by your parents, you can have your dessert, but you got to eat your veggies first. And I think the veggies is the planning, right? So it's kind of like, all right, well, why am I doing this? I'm doing this because I want a Ferrari, or I'm doing this because I want to retire on $100,000 a year, or I want to retire at 55 instead of 67. And then you can kind of figure out, all right, to achieve that, I need these types of properties. I need this type of yield, so I still look attractive to the banks as I continue to grow, and I need this sort of performance. I think if you're not doing that first, you're just going straight to your, what would have been when I was growing up, the Viennetta box ones. Like that was the height of luxury, like those were only for special occasions as a poor country kid, right? We had to have guests over, and even then I only got a slither, right? You can't just race to that. I think that's the hot spots, right? And I was talking to a professional hot spotter the other day, and he was kind of saying, I actually don't, like, it's my job. I'm known as a hot spotter, but what I'm actually trying to do is find locations that will outperform the market over time, not like flash in the pan sugar hits, right? But we get so excited about that. Oh, we've got pre-approval. Like let's get the property. I think we do need to slow down and go, what are we actually trying to achieve? It's not fun. It's not sexy. I mean, you wouldn't expect anything fun and sexy from a quantity surveyor, basically an accountant. But it needs to be done if you are serious about the results and you want to treat your portfolio like a business, which I think everybody should.
Absolutely. Spot on. Agree with you on treating your property like a business and knowing what your business or property goals are, and reverse engineer it from that. What's your age 55 retirement look like? Is it the 100K income a year, 50K income a year? And then how do you go back to where you're at today, and then build that portfolio out in a somewhat linear fashion, as much as you can predict what the market might do.